in this next adjustment, we are required to calculate something called cash reserves and statutory liquidity reserves. Okay, you're already aware of what these two mean. Basic requirements of the RBI, wherein a certain amount of the cash that has to be maintained with RBI, and a certain percentage of all your liquid assets of the bank also has to be kept aside. Now, percentages are given to you of the cash reserve and liquid reserves, and you're supposed to calculate it on something called demand and time liabilities. Okay, now in order to calculate these reserves, first let's understand what these demand and time liabilities mean. In schedule 3, we maintain something called deposits, and three different types of deposits are there in this problem. That is your fixed deposit account, savings deposit account, and the current deposit. And I'm talking about the current deposit with a credit balance that is put under schedule 3. Okay, so when you have such liabilities, when the bank has liabilities in the form of deposits, these three can be classified either as demand liabilities or they can be time liabilities. So what exactly does this mean? In case of, let's say, the first two, let's just take an example here. Say you have things like type of deposits like savings accounts and current accounts. Okay, now these are the type of accounts from which a customer can withdraw at any point of time, correct? Through an ATM, through bank slips that you give physically or personally. In that form, you can withdraw amount from your savings bank or your current account at any given point of time. So these two are normally termed as demand liabilities, which means that the customers who have kept these deposits with the bank, they can demand them at any point of time and withdraw their money. At the same time, when you have certain deposits like a fixed deposit or a certain term deposit, okay, certain schemes of the bank wherein you maintain the amount for a certain fixed period of time. Now these type of deposits have something called a maturity period, right? That is like, let's say if you're making a fixed deposit, you normally would make it for a year, 2 years, and so on. It may get renewed and so on. In this case, since these deposits remain with the bank for a fixed period of time, these are known as time liabilities. All right. The customer who has maintained these deposits with you cannot withdraw from that fixed deposit account every now and then. He can, of course, close the deposit and take the entire money, in which case he will lose part of the interest, but he cannot withdraw on a regular basis from those fixed deposits. They remain with the bank for a certain fixed period of time up to the maturity date. Okay, whereas in case of demand liabilities, the savings and current account, there can be withdrawals from the account on a regular basis. Of course, there may be certain limits that the bank has as to how much you can withdraw from your account in a day or how many times. But even in that case, it is still a demand liability. Okay, so when we calculate these reserves, both cash reserve as well as statutory liquidity reserve, we calculate it as a percentage of these three demand and time liabilities, right? So right now we have three over here, and I would transfer all these three to this demand and time liability calculation. Okay, so take these current accounts, we put them in the inner column so that we can accordingly do the calculations. Fixed deposit accounts, and savings deposit accounts. You don't need to show the bifurcation as to which ones are demand and time liabilities. You just need to total up all of these three. So we already have the total here, but we'll just show it separately. Okay, and the total of those demand and time liabilities is 1487.12. Okay, just write it here, total of demand and time liabilities. You may or may not show the entire working note, the whole calculation all over again, but you need to specify which of these you have included as the demand and time liabilities. Okay, so this is the amount on which we are going to calculate the percentage of the reserves. 3% for cash reserve ratio and 30% for your liquidity ratio, statutory liquidity ratio. Okay, so in the next calculation, we'll write over here working note 4, I will say cash reserve required. Now this is the amount of cash reserve that we are supposed to maintain, that the bank is supposed to maintain. Okay, now whether it has been maintained or not, we are going to check from the amount that we have, which is maintained with RBI. So 3% of 1487.12, you get roughly 44.61. Okay, and similarly, if you calculate the liquid ratio or liquid reserve which is required, you get 30% of the same amount demand and time liabilities, and you have 446.14. So these two reserves we have calculated, they're very important and we're going to show them accordingly. And based on this cash reserve which we are required to maintain, we need to compare this with what has already been maintained with RBI.